On the morning of March 30th, 2026, three people looked at the same red screen. Lloyd was in a grocery store parking lot, phone in one hand, cold brew sweating in the cup holder, refreshing his brokerage app for the 11th time before he'd even gone inside. He sold everything at 10:22 in the morning. He knows the minute because he screenshotted it. Nadia was at work. She didn't look. Her phone buzzed twice with news alerts and she swiped them away like mosquitoes because 7 months earlier she'd written one sentence on an index card and taped it inside her desk drawer. Gwen has $300 million. Her family office called that morning. The call lasted 4 minutes. Nobody sold. By the middle of April, the market had recovered every point it lost. Two of those three came out ahead, and the smallest account is in that group. Spoiler alert, none of them saw it coming. Not even the woman paid a fortune to see things coming. My name is Nick, and today I'm going to take apart the most expensive myth in personal finance, which is your quiet suspicion that rich people get a warning you don't. They don't. Nobody does. What they have instead is boring, mechanical, and mostly free, and by the end of this, you'll be able to copy about 3/4 of it. If you've ever watched your account bleed and felt like there was a room you weren't invited to, hit subscribe, because we're walking into that room right now. And I want to say something to you before we go a step further. If you've ever sold something in a panic and watched it recover 2 weeks later, you are not the idiot in this story. You'll see in a minute that you behaved better than the professionals did. If that sounds unlikely to you, good, stay right there. Let's start with what the data says, because it demolishes the premise almost immediately. Every year, the Swiss Bankub surveys single-family offices, the private investment operations of individual ultra-wealthy families. The families in the most recent report averaged $2.7 billion in net worth. If anybody gets a warning before you do, it's them. They get research you will never see. They can hire a former Treasury official purely to have opinions at them on Tuesdays. So here's what they plan to do with all that insight while you were reading headlines and wondering if you should move to cash. 59% said they'd run the exact same portfolio risk as the year before, only 35% expected to change anything at all, and when reality handed them a live test, most made no dramatic changes whatsoever. They describe their own positioning with the least exciting phrase in finance: all weather. $2.7 billion, and the plan was to sit there. Now there's counter evidence, and you should have it. Capgemini, which polls wealthy individuals rather than institutions, found cash at 26% of the average portfolio at the start of last year. A year later, it had dropped below stocks as money moved back in, so somebody was moving. But look at the direction. They didn't run to cash before a decline. They sat in cash collecting interest, got bored, and chased the market up. That is not foresight. That is what you did, with more zeros and better wallpaper. So if the best informed money on earth isn't predicting downturns, what is it actually doing? The first answer is that wealthy people mostly aren't investors in the way you and I use that word. They're owners. And that difference decides almost everything about how your March goes versus how theirs goes. Here's the number that reframes everything. The top 1% of American households hold roughly 53% of all the private business equity in this country. Not stocks, private companies. Stakes with no ticker, no price quoted every 11 seconds, and no way to sell them in a panic at 10:22 in the morning from a parking lot. And when the Richmond Fed broke down the survey of consumer finances, they found something brutal. Almost wherever you sit on that ladder, your largest asset is your house. Only in the top 1% does business ownership finally outweigh the home. So if you've wondered why your net worth never feels like theirs, that's why. Yours is a place you sleep in. Theirs is a thing that earns while they sleep. So Gwen's portfolio isn't a better version of yours. It's a different species. Nearly half of it sits in things with no continuous price and no exit button. Your portfolio, meanwhile, can be liquidated during a commercial break. And here's where the industry hands you a half-truth, so let me give you both halves. The half they tell you is that private equity holds up better in crashes. On paper, it does. In the financial crisis, the buyout market fell less than 13%, while the S&P 500 fell about 40%. The half they leave out is that private assets get valued by appraisal, not by auction. Nobody marks a regional plumbing company to market every 90 seconds, so a good chunk of that beautiful smooth line isn't less risk. It's the same risk with the volatility quietly removed from the chart. It's not that the storm was gentler over there, it's that nobody sent them a photo of the roof. But that distinction matters less than it should, because the outcome is real even if the mechanism is unflattering. You cannot panic sell something that has no buyer. Illiquidity isn't a flaw in Gwen's portfolio. It's the safety mechanism. She's protected from her own worst instincts by paperwork. You are not. You have a sell button, and it is always 11 inches from your face. Which brings us back to Lloyd. Let's do his math honestly, because the standard version of this argument is lazy and you deserve better. You've heard the missing the best days statistic. Leave $10,000 alone in the S&P 500 for the 20 years ending in 2023, and you'd have $75,242. Miss only the 10 best days, and you'd have $33,473. You'd have lost more than half your money by touching it 10 times. 10 days out of 5,000. Now here's the part nobody includes, and leaving it out is a form of lying to you. Morningstar ran the mirror image. If you'd missed the 10 worst days, you'd have beaten the market by about 2.66% a year. Missing the 10 best cost about 2.40% a year. Those are nearly identical. So the honest version isn't that timing is mathematically impossible, it's that you'd have to be right twice, and the two events are welded together, because the best days and the worst days are neighbors. The median gap between one of the 10 worst days and one of the 10 best was 7 days. 7. The market's greatest single-day rallies aren't scattered across calm afternoons, they're packed into exactly the fortnight when your hands are shaking. To catch one, you have to buy on the day the news is worst, which is the day every instinct you own is screaming the opposite. Lloyd sold on March 30th. The bottom was March 30th. He didn't miss the bottom by a little, he personally attended it. And before you comfort yourself that professionals are immune, in 2007 Warren Buffett bet $1 million that a plain index fund would beat a basket of hedge funds over 10 years. The index fund returned about 126%, the hedge funds returned about 36%. But sit with the twist inside that, because it's this whole video in miniature. Those hedge funds won 2008, they fell about 24% while the market fell 37%. They did their job perfectly in the exact year everyone feared, and then spent 9 years giving it all back. So understand what you're buying when you buy protection. It is never free, you pay for it in every year that isn't a crash. And there are a great many more of those than there are crashes. So if they're not forecasting and they're not buying protection, what on earth was happening in a 4-minute phone call that ended with nobody doing anything? Nobody made a decision that morning. They executed decisions that had already been made, which is the one thing in this entire video you can copy for free today before you finish your coffee. That's the whole thing. Wealthy portfolios don't have a better crystal ball, they have a written instruction set, and a downturn is just the event that triggers it. So let's build yours. 4 items. 3 of them you can do this week, and I'll be honest with you about the 4th. Item 1. Rebalance on written bands, not on feelings. You decide in advance that if your stocks drift more than 5 percentage points from your target, you sell what's up and buy what's down. Automatically, no meeting, no opinion, no cold brew. And I know that sounds like nothing, so watch what it did for people exactly like you. When Vanguard studied over 5 million households through the March 2020 crash, 83% of ordinary self-directed investors made no trades at all. 9% actively rebalanced into the decline, which means the story about panicking retail investors is mostly fiction. And here's the detail that should irritate you. In this past March's drawdown, buyers outnumbered sellers roughly 4-1 on the heaviest days, and the sellers skewed older and wealthier. Median age of the sellers, 56. Median age of the buyers, 40. The people supposedly too naive to know better mostly held. Nadia held. Lloyd, who reads 3 newsletters and could explain the yield curve to you at a party, did not. Item 2. Harvest your losses, because a downturn is inventory. Vanguard estimated that $1 million index position would have thrown off about $385,000 in harvestable losses over a decade. That's worth roughly 0.85% a year to you in a top tax bracket. And nothing leaves the market. You sell the loser, buy something similar but not identical, bank the loss on paper, and carry it forward forever. Two rules you need. You can only deduct $3,000 of losses against ordinary income each year, though the rest carries forward indefinitely. And the wash sale rule means you can't rebuy a substantially identical security within 30 days, which is the real reason wealthy people own hundreds of individual stocks instead of one clean fund. It isn't sophistication. It's that owning 300 things gives you 300 ways to sell one and buy its cousin. Lloyd, by selling everything in a taxable panic, did the exact opposite. He realized gains he didn't want and locked in a loss he can't use, which is a genuinely impressive way to lose twice in one transaction. And the honest limit, because this decays. Once your cost basis drifts up, the annual value drops to around 9 basis points, which is a rounding error. Loss harvesting is a gift a downturn hands you, and it's biggest the first time. Item 3. Convert when prices are down. Moving your money from a traditional retirement account to a Roth costs you less when values are down, because your tax bill gets calculated on the smaller number while your entire recovery lands somewhere it will never be taxed again. For 2026, you can put $24,500 into a 401k and $7,500 into an IRA. One change catches people this year. If you earned more than $150,000 from your employer last year, your catch-up contributions now have to be Roth, not optional. Nadia converted a slice in April. It was not dramatic. She did it on a laptop, on a couch, in about 9 minutes. Item 4 is the one you probably can't use, and I'd rather show you than pretend it isn't there. When valuations are down, wealthy families move assets out of their estates at the bottom using trusts and family loans, so the entire recovery happens in someone else's name. The estate and gift exemption now sits at $15 million per person and $30 million per couple, which means the planning problem here is what to do about your second $30 million, and if that's your Tuesday, congratulations, genuinely, that's Gwen's world, not yours, and I won't insult you by pretending otherwise, but steal the logic, because the logic is free. A downturn is the cheapest moment to move an asset from where it is to where you want it permanently to be. For her, that's a trust. For you, it's a Roth or a brokerage account or that savings balance you've been babysitting since March. Now let's talk about the version of all this that gets sold to you. Because there's an entire industry monetizing the feeling of investing like Gwen. Buffer funds, which cap your upside in exchange for cushioning some of your downside, have exploded to around $78 billion. By fund count, they're now the largest category of exchange-traded fund in existence. And they do exactly what they promise. That isn't the problem. The problem is the arithmetic. The largest provider charges about 0.88% a year. So you're paying nearly a full percent, surrendering your dividends and capping your best years to soften your worst ones. Run that across a full cycle and you've rebuilt Buffett's hedge fund bet from scratch in fund form with a much nicer app. Cash gets misread the same way, and you've probably seen this one on your feed. American money market funds hold a record $7.9 trillion, and every few weeks somebody calls that dry powder waiting to buy the dip. It isn't. It's yield. Short-term rates finally pay something, so cash filled up. Those balances have essentially never predicted where stocks go next, and anyone telling you otherwise is selling you a feeling. Even Berkshire Hathaway gets misread this way. Its cash pile sits around $365 billion, and people read that as a crash warning. But the stock is up about 3% this year, while the market is up 13%. That gap is the price of caution paid in real time by the most patient investor who ever lived. Which brings me to the two men who actually called it, because their stories are the most useful thing here. Michael Burry made investors around $700 million shorting subprime mortgages. Historically, completely right, and if you've seen the movie, you already like him. Then he spent a decade making bearish calls that didn't land, exited GameStop before the squeeze that would have made him a fortune, and last November shut his fund entirely, writing that his estimate of value hadn't been in sync with the markets for some time. John Paulson's funds made about $15 billion in 2007. 4 years later, his flagship fund was down 36%. By 2020, he'd handed back all outside money and become a family office. Both men were spectacularly right once, neither could do it twice. So, if the two greatest downturn calls in modern financial history have a repeat rate of 0, I'd gently suggest that the guy on your feed who is positioned for what's coming has not quietly solved a problem that beat both of them. So, where does that leave you? Sitting there with a number in your head you don't like? Let me say the part that isn't a tactic. If you're doing the math right now on how many months of contributions just evaporated, or checking a balance you already checked 40 minutes ago, or wondering whether the responsible thing is to step aside until it's calmer, you are not being stupid. You're being a person. The urge to sell into a decline isn't a character flaw. It's a correct threat response running on hardware built for predators, applied to an app that updates every 11 seconds. And the stakes aren't symmetrical, which is the part almost nobody tells you. If you're still working and still contributing, a crash is a discount and you should want it. If you're drawing income out of that money, the same crash is permanent, because every dollar you withdraw at the bottom is a dollar that never comes back for the recovery. Same market, opposite meaning, and nobody stops to ask which one you are. The system isn't failing you because you're bad at this. It's failing you because it hands you a live feed of your net worth and a one-tap sell button, then acts surprised when the two find each other. Gwen's protection is that her assets are legally hard to sell, and her decisions were made in a conference room in January. Yours has to be built on purpose, because nothing in your setup builds it for you. And if building that deliberately rather than by accident sounds like your kind of thing, we run a school community for exactly that. Links in the description. Anyway, here's something else worth noticing. You'll hear that American households now hold a record share of their financial assets in stocks, somewhere around 45%, and that it's a warning sign. But that's an average, and that average is doing enormous work because the top 10% own the overwhelming majority of those shares. For the median household, stock exposure is a rounding error next to the mortgage. So when the news says Americans are dangerously exposed to the market, understand that Americans is mostly Gwen, and nobody knows what's coming, including me. The Shiller price to earnings ratio sits around 41, which is roughly the 99th percentile of every reading since 1881. That sounds ominous. Meanwhile, volatility is sitting near 15, which is calm, and recession estimates right now range from about 15% in one Federal Reserve model to about 36% in another. Same institution. Different models, 21 points apart. That spread is the most honest thing in this entire video. One building, two computers. 21 percentage points of disagreement about whether the economy is fine. So do this before you do anything else. Write one sentence tonight that says exactly what you will do if your account drops 20%. Set your rebalancing band and automate it so that no human being has to feel anything on the day it triggers. And decide right now how long you'll go without looking. That's it. That's your version of Gwen's January document. 15 minutes, and it requires no forecast whatsoever. Because March 30th is coming again, and you don't get to pick the date. Gwen's calendar that morning wasn't a trade. It was a document she'd signed in January, telling her advisors what to do at specific thresholds without calling her. Down 15%, rebalance, down 20%, harvest, and convert. She wasn't consulted on March 30th because January Gwen did not trust March Gwen. That's the entire trick, and you can run it with a text file. She fired herself from the job of reacting, and you should fire yourself too. Nadia's index card said in her own handwriting, if it drops more than 20%, buy, and do not check again until June. She caught the same rebound. She harvested a smaller pile of losses in a smaller account. She got most of what Gwen got, minus the trusts, minus the guy paid to have opinions at her on Tuesdays. Lloyd is the only one who lost, and here's what he was actually wrong about. It wasn't the market. He never made a prediction at all. He let the decision get made by whichever version of himself happened to be holding the phone in a parking lot on the worst day of the year. And that version of you is always the most frightened one, because the frightened one is the only version that's checking. I'm not a financial advisor, and this isn't financial advice. Check every figure here against current data before you act on it, because several of these move weekly. The wealthy don't invest before a downturn. That's the part that took me years to understand. They decide before a downturn, and then they arrange their lives so the deciding version of them is nowhere near a phone when it arrives. The market will not reward you for seeing it coming. It rewards you for having already written down what you'd do back when it felt unnecessary and faintly dramatic to bother. The best time to write that sentence was January. The second best time is tonight while nothing is happening. And if you want company while you do it, you know where we are.